and thanks for shortlisting this paper for the presentation. I look forward to the comments. So just to give you a background, basically, we were trying to look at what was happening with the investments in China during GFC, and at that time, my co-author, basically, Wei, came across this anomaly that foreign-controlled firms were paying exceptionally high dividends in China during that time. And then we started developing the project accordingly. Okay, so I'll keep it quite brief, basically. So I'll give you a snapshot of the paper more in bullet points, basically, what exactly is happening. So post-liberalization, foreign capital has exposed domestic markets, especially emerging markets, to a significant amount of international risk. There's a whole bunch of literature out there. Then the influence of global financial crisis on corporate policies and shareholder value in international market has attracted a whole bunch of articles in last 4 or 5 years in premier journals. So some notable ones are Barbara Bliss and David Dennis's in 2015 JFE, which basically looks at a significant reduction in payout policy by the US firms during 2008-9 period. Then Pincili and Chagini document change in risk premium of long-term debt in the European Union. Rudolph and Schwarzer investigate the effect of 2008-9 crisis on the valuation of MNCs throughout the world. And finally, Atig in, I think, financial management basically report a significant dividend reduction in 9 East Asian countries during GFC, sans China. So China wasn't a part of their sample, basically. Now, what about China? Like, why is China important? Or how, more importantly, who are foreign investors in China? So China opened up Shanghai and Shenzhen stock exchanges back in 1991. Around 75% of the total foreign portfolio ownership in China is held by the firms or the parent firms which are based either in US or Canada or in Western Europe, basically. Now, foreign investors can invest in China through two different routes. Either they can be portfolio investors, which on an average have close to 2.23% ownership in the firm. So they invest either through QFII or B shares. Long story short, if you have that's the 2.23% is the average ownership that they can have, or they generally have as portfolio investors. So if you have a 2 or 3%, or at the most 3 or 3.5% ownership, you cannot really be a major player in terms of the policy decisions, right? What is significant and what we are trying to focus in this study is the direct investors, which was basically proposed, or which was basically started by the Ministry of Foreign Trade and Economic Cooperations back in 2001, and they can even invest after the firm has come up with an IPO. And finally, what we are looking in this paper is, we are looking at a period between 2005 and 2014, all A shares, non-financial, non-utility, non-cross-listed FIEs. So Chinese-based firms which are owned by foreign investors. In total, we have got 801 firm years, and the average shareholding of the foreign controlling shareholder is 37% in our sample. So if you have a 2% shareholding, you cannot really be a significant player when it comes to policy decisions. But if you have a 37% shareholding, then definitely you can govern the board, or you can be a significant player when it comes to board decisions. Sorry? What's the maximum? I'll have to look at the charts, but I think it is close to 49 or 52, something like that, basically. But the standard deviation is relatively low in that case. The reason we started in 2005 is because between 2004 and 2005, Chinese firms went through the split share structure reform, where the owners or the legal owners were able to list their shares on the stock exchange. It was a government initiation to increase the liquidity of the capital market and the firms, basically. Now, just a brief overview of the literature about foreign investors and dividends. Overall, foreign investors in emerging stock markets are known to invest in firms with stronger corporate governance and with higher dividend payout policy. Dividend payout may be used as a mechanism to monitor free cash flow problem to mitigate the agency conflict, while at the same time, high dividends can constrain investments, especially during the onset of global financial crisis or during external financial shocks. In terms of Chinese context, there is a paper, the results are quite mixed, basically. There is a paper by Huang in JCF, which show that dividends are used for intergroup tunneling, while at the same time there is a paper which came out last year by Michael Firth, who reports that dividends are used more as a monitoring mechanism. Long story short, the role of dividend payout during the times of financial crisis has received insufficient attention, especially in context of the emerging markets. We were able to find only one paper from Barbara Bliss and David Dennis, which looked at the payout policy on US. Then there was one paper which looked at a mixed sample of the East Asian countries, and then nothing specific to China or nothing specific to what was happening in terms of foreign investors, basically. What we found in the literature was what was happening in the country as a whole, but not with specific to one specific pool of investors. So this is our basic motivation. First, we seek to offer new information regarding the impact of payout policy of foreign-controlled Chinese firms on firm-level performance and investment decisions. And then finally, what is happening after the firms. So we are looking at a 10-year period from 2005 to 2014, and during this period between 2008 and 2009, we find this group of firms suddenly end up paying very high dividends, right? If they are paying higher dividends during those 2 years, then this must affect these firms after the crisis is over, right? So that is the next part that we try to explore, or that we try to answer in the second half of our paper. So again, these are the key highlights of our paper. We conduct difference in difference analysis to test a large sample of Chinese firms. Our key findings are foreign controlled ownership is associated with larger dividend payout during financial crisis. This result is particularly strong when using QFI invested firms as a control sample, indicating a difference in influence of foreign controlling ownership compared with foreign portfolio shareholding. So just to, once again, just to stress basically, if you are in this category, you cannot really force the board to pay higher dividends. But if you are in this category, basically, you can force the board to pay higher dividends, right? So that is the biggest difference, or that is the main difference that we are able to find, or we are able to report in this study. As a consequence of dividend increase, firm investment dropped during the GFC period, which led to a significant underinvestment problem among these special foreign controlled firms. And finally, these findings are consistent with dividend increase acting as a vehicle for expropriation of liquidity by foreign controlled shareholders during the period of financial crisis. These are main research implications. The key finding is that we are able to reveal a significant principal agency conflict in our paper. So principal is basically the interest of the major shareholder are not aligned with the interests of the minority shareholders in the firm. Our two main hypotheses are FIs paid higher dividends during the period of GFC than domestic firms, and also relatively higher payout compared to what they would pay during the other times, so before the crisis and after the crisis. Secondly, our second hypothesis is dividend increases for FIs during GFC was negatively associated with future firm level investments and positively associated with underinvestment. So to simply put, significant higher dividend payout during GFC led to a significant underinvestment problem after GFC. These are our key summary stats. Our total sample is close to 18,500, which of this 800 firm years are for FIEs in our sample basically. Okay, now here are the results. Basically, I'll highlight the key results. So as you could see, FIEs during the crisis period, whether you include firm controls or you do not include firm controls, the average payout is highly significant. While at the same time, in the post-crisis period, they suddenly reduce their dividend payout. In general, there are mixed results in terms of the average payout policy by the FIE controlled firms. So if you look at the full sample period, the results are relatively mixed. But especially during the crisis period, they end up paying relatively higher dividends, and due to the higher dividend payout during this period, there is a significant drop in dividend payout in the post-crisis period. And if you look at the journal crisis period trend, during that period, the average payout policy by the Chinese firms went down. Now, in China basically, when it comes to leverage, like India, actually, their bond market is worse than India. There is hardly any fixed income market. So the only form of borrowing that the Chinese firms have access to is 4 national banks, basically, or 4 state-owned banks. Now, that's kind of a good thing, basically, in Chinese context, because they were able to limit the expropriation. Or so if the average leverage of these firms was significantly higher, of these FIE firms was significantly higher, then these bondholders or these banks were able to limit the higher dividend payout. But, and this was the only silver lining out there, basically, or a limiting factor. Next, if you look at the institutional investors in China, they are predominantly concentrated among mutual funds, basically. There's a paper, I think, in JBF back in 2016, which looked at institutional investors in China, and it is predominantly based or focused among mutual funds, and these mutual funds prefer investing in firms which pay higher dividends. And again, if you look at a triple interaction, the dividend payout was significantly higher during the crisis period. Our results further collaborated with the literature, which said that the institutional investors preferred investing in higher dividend payout firms. And the other results pretty much remain kind of consistent with what we found initially, basically. Okay, these days, if you just report the results, it's not going to get you anywhere, basically. So you finish your results in first 3-4 tables, and then you have to have a whole bunch of robustness checks. And somehow everyone wants an answer to endogeneity. So we start with PSM model, although it is not exactly addressing endogeneity, it is just addressing the idea of sample selection problem, basically. So we follow the standard literature. We use a whole bunch of standard matching criteria. And we, out of 800 firms, we are able to find close to 380 firms for which we have a perfect match, basically, of domestically owned firms. By using PSM approach, all our results remain consistent. So in case of excess leverage, there is a decrease in dividend payout. In case of institutional shareholding, there is an increase in payout. And in general, there is a increase in dividend payout by foreign controlled firms during the crisis period. So our results are good in this case, basically. Okay, so we have been able to establish this anomaly that during the period of crisis, these special group of firms were paying exceptionally high dividend. Okay, what next? If you end up messing things in one period, 1 minute. Okay, then quickly. Modigliani-Miller proposition, or the Modigliani-Miller theory, is literally out of the door during the period of financial crisis, right? So what is happening is, this may lead to significant underinvestment problem, basically. And that is what we are basically reporting here. So the firms that increased their dividend during the crisis period either had negative investments or significant underinvestment problem. We found insignificant result in case of the firms when the firms decreased their dividends. And we reported that using 2 different parameters, dividend per share and dividend to total assets. The results remain consistent. We check using PSM method. The results still remain consistent. And finally, in the post period, basically, what we also find is the firms that increased their dividend during the crisis period observed a significant decline in their earnings, in the post-period earnings or return on assets, and a significant decline in their sales growth and change in sales growth. And that's pretty much it, basically.
Thanks.
Sorry for literally rushing through the last phase, basically.
Thanks. Pab is the discussant. While he gets into this, I want to tell a story about the Indian firms and the GFC. The story we find is that the firms who were doing money market borrowing in London choked with dollar liquidity in London. So they borrowed in India, took it out as dollars to be able to meet the rolling over of debt in London. So there was a liquidity transfer, but it was a different set of firms. It was the firms who had borrowed in London who had a dollar crisis in London.
And that was in 2008?
Yeah, October 2008. let's do email. I'll point you to that. Pab, you have 10 minutes.
Okay. Okay. All right. Thank you very much, Susan and Pradeep, for inviting me to discuss this very interesting paper. Since Abhinav presented pretty well, so I'm going to summarize very quickly that the paper empirically demonstrates using difference in differences that foreign control firms in China increase dividends relative to matched domestic control firms during the 2007-9 financial crisis. They also show smaller effects among firms with excess leverage, right, suggesting that creditors may play a little bit of role in monitoring dividend payments among these firms. And they also show larger effects among firms with high institutional ownership, which their claim suggests that the institutional owners tend to focus on short-term outcomes, and so they prefer dividends. And so these firms that increase dividends during the crisis also tend to invest less than other firms in the same industry, and they interpret this as underinvestment. So the interpretation of all of this evidence together, the authors seem to think that this means that the foreigners facing financial constraints elsewhere outside China tend to expropriate liquidity from China through dividend policy. Okay? So my thoughts, I think the paper provides quite relevant and interesting piece of evidence, basically showing that liquidity or funding can be transferred across countries through dividend policy. Overall, I think it is carefully done, and it provides novel contributions to the international finance and corporate finance and governance literature. However, I do have a few comments, and I'll go over them one by one. The first one is that I think the motivation, the pitch of the paper is very confusing, as you can see from the first slide of Abhinav, that he listed a bunch of different papers that come from different literatures that the paper sort of appeals to, ranging from the literature on dividends to agency conflicts to foreign ownership of domestic firms to transmission of liquidity to benefits of financial slacks during the crisis and so on and so forth, right? Now, there's a difference between whether or not the evidence contributes to some of this literature versus whether or not you should, harbor all of them in your motivation, right? So here, I would suggest if you want to publish in a top journal and draw the right referee in the process, less is more. I want you to make a choice which one you think is the best one and just keep pounding on it, right? That would help the editor pick the right referee for the paper, because otherwise, seeing all of these literatures, the editor is confused, like, who, he or she should send the paper to. Now, what comes to mind, and indeed, I think, I was right. After I do a search, I found a paper that is quite related and similar to this particular one, is the role of internal capital markets. I don't see this term being mentioned quite prominently in the paper, but I think it is one of the most sort of, obvious thing that come to my mind after I read the first 2 pages of the paper, is the role of internal capital markets in transmitting shocks across borders, okay? And this is related to this paper by Kopalan, Nandan, Saru in the RFS 2014, which shows the same kind of thing within a conglomerate in general, right? It doesn't say that this thing transmits, shocks across borders, but it shows that, the conglomerate used dividends to reallocate capital and liquidity within the group. Now, if you interpret the evidence that way, it will complement my paper with Chris Lundblad and Tarun Damodarai very nicely, right? Because in this paper, we have 2 papers, one in JF, the other one in JMF, which basically focus on the role of external capital markets in transmitting shock through 5 sales of equities owned by global funds, right? So in this case, you say, foreign investors don't have to fire sales in the external markets. They can just use some corporate policies if they own enough equity stake, right, to basically reallocate liquidity and capital, right, from firm in China to some other firms in other countries. So this evidence also has important policy implications because it basically proves wrong the general notion that FDI is a great thing, right? In the sense that it protects the host countries from hot money and international contagion and so on and so forth. But this is not completely true, right? Because FDI could also expose the host countries to this type of behavior where liquidity and capital could still be reallocated, right, within the group. Second, again, with the goal of publishing in the top journal, you have to be more convincing in telling us why you picked China, right? What is the significance of that, and whether or not the results that we learn from this paper can apply more broadly to other countries as well, right? And currently, the authors state that, oh, China is a very dominant country. A focus on China is valuable for gaining understanding of how foreign ownership facilitates liquidity shift, right? But it is not clear at all. Just because China is big doesn't mean that what we learned there is going to apply to India or to Pakistan or to Thailand or to Chile, right? Because China is likely somewhat special, maybe not compared to India, but to many other countries in the sense that it has pretty tight capital control. It has somewhat heavily regulated currencies and so on, right? And also on foreign ownership as well. And so as a result, what we learn from China may not actually apply, right, to firms in other countries. And third, of course, the burden of identification is always high in a top journal, right? In this case, the authors try to use DID, couple of, with the propensity score matching and falsification tests to address endogeneity. But the form of endogeneity that are of the most important concerns, I don't think can be addressed by all of these techniques, right? And these are the two things that I think are of the most concern for this particular paper. Is that the first thing is that there might be some omitted or unobserved variable that drive investment opportunity of these foreign control firms, right? That you don't really get to observe. And so as a result, these firms, right, take more cash out because they don't have opportunities to invest in China, and then the cash is better used somewhere else, right, where they might face financial constraints or maybe have better investment opportunities. So in this case, the control group should be the firms that face the same kind of variation in investment opportunity, not just the firms that sort of tend to pay dividends in the same way. Second, the driver may also be actually conglomerate, really not really about foreign versus domestic, right? Because maybe the subsidiaries of even Chinese-owned conglomerate may also behave in a certain way, right? Where the conglomerate reallocate money and capital across different subsidiaries, right, in order to put the capital and liquidity to the best use within the group, right? And so in this case, the control group should be subsidiaries of the conglomerate rather than some of these things that you're using, right? So more generally, I think you need to give a little bit more institutional background on these foreign control firms and the kind of regulations that are in place, right, to understand their unique circumstances. And so, and on top of that, knowing the identities of the foreign conglomerates that own these firms could be helpful, right? Because not all foreign control firms face the same liquidity constraints outside China, right? So the firms that are owned by some other groups in the US may face more financial constraints than the firms that are owned by firms in the UK or Europe and so on and so forth, okay? So I'm gonna, for the interest of time, I'm gonna skip the interpretation of the results, but I think the interpretation that is expropriation is a little bit questionable, right? I think you kind of wrap that interpretation even before you start, your analysis of all of these, right? So in fact, it's just a reallocation of liquidity and capital within the group, right? And there's nothing wrong with that, right? It might affect some minority shareholders of the subsidiaries in China, but it doesn't mean that it's necessarily a bad thing, right? So again, just to conclude, it is a relevant and well-executed paper. I think it provides novel contributions to several strands of the literature. my main wish is that it is more focused, its motivation has convinced me why they choose to analyze China and to pay more attention to specific forms of endogeneity, not just blanket things that like just check box, 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 right? But it has to sort of be relevant to the kind of thing that you think would concern readers, right, for this particular context. And finally, you should be more careful in interpreting the results. Thank you.
Thanks a lot, Pep. Let's first gather some more thoughts from the floor. Yes, please.
So do you observe any valuation implications of the fact that some of your treatment firms have high FIE? I mean, ex ante, you would expect that if you believe it's resulting in some suboptimal decisions, that some sort of valuation ratios would be lower for your treatment firms versus the control firms, or you would see some sort of abnormal negative performance for these firms. After all, your interpretation is it's suboptimal underinvestment because of this corporate policy.
Sorry, by valuation you mean the market value of the firms, basically.
Right.
So basically, our matched firms have exactly the same characteristics during the time of the crisis and before the crisis. And
is that what you would expect if you think ex ante, that everybody knows that these have high external investors, and therefore they may behave in a suboptimal way if there is a crisis? I don't know. What are your priors, and how do you?
I'll have to look into them, but as far as I remember, basically what we did was we look at the criterias, the firm level criterias before the crisis and at the time of the crisis, the whole bunch of firm, and then we basically go out and look at their performance, investment decisions, or their investments and underinvestments after the crisis, basically. So that's the criteria. So valuation was one of the matching criterias, basically.
So should it be a matching criteria, or should it be some sort of an outcome criteria? That's my. So investments is your outcome criteria, right?
Yeah.
Yeah. So so if you know that there is a firm that has high foreign investors, and therefore they would behave in a certain way, would you expect ex ante to have those?
But why should they behave in a different way? If you are in a particular country, if you are in Rome, act like a Roman, right?
But that's your hypothesis, right? You're expecting that they would behave differently.
Yeah. So our hypothesis is basically, if the country or if there is a period of financial crisis, you should save money, right? A penny saved is a penny earned during that time. So why would you be distributing that as a dividend? Because at that time, the sources of external finance become expensive, right? So either you invest that in the firm, or you basically retain cash because that's what we observed, or that has been reported in the literature for US or other Asian countries.
Can I just come back into this? Who are these investors? So if I think about India, we think that a lot of foreign investors into India are pension funds, are insurance companies, who frankly don't have liquidity problems in a crisis. When I think about financial intermediaries and the buy side having liquidity difficulties, I think of Harvard Endowment Fund, who reneged on drawdown statements, drawdown notices from private equity funds at the time of the 2008 crisis. But mostly, I don't think investors had a big problem at the time of the crisis. So do we know something about who these financial organizations are?
Actually, that basically comes back to Pab's third question, actually. So when you're working on China, you get your data from SESMR, basically. And SESMR does not disclose the identity of the parent firm or the foreign investor. Now, most of the foreign investment in China is done through mutual funds or institutional investors, basically.
So why would they have such a big jam on liquidity in October 2008? Mutual funds are just natural longs.
These are mutual funds, though, because on average, they own 37%. Mutual funds are not going to own 37%, and it was transformed from being a foreign direct investment into becoming a listed firm in China, right?
Okay,
so it's more likely that these are basically subsidiaries of some sort of foreign conglomerate. It's unlikely to be mutual funds or pension funds.
But mutual funds might be a source who would be channeling their money, basically.
Well, the mutual fund might own the conglomerate in the US or in...
Yeah, that's
but they're unlikely to be the main owner who control all this chain of decision.
Okay.
It's unlikely.
So I would just suggest, can we think a little more about who are these owners?
As I said,
And
we do not
to
have
carry,
ac-
to
we
carry,
do not, sorry.
no, it does not even have to be firm data, but just can we get a rich understanding of that landscape? So as an example, if you were here in India, no, you do not have data firm by firm for who the owners are, but you do have considerable knowledge about the nature of these investors. And what we in India call foreign institutional investment is indeed foreign institutional investors. They are pension funds, they are insurance companies, they are hedge funds, and then you'd be telling this kind of story that Pab and Tarun have been telling, that maybe emerging market mutual funds experienced large redemptions and they were starved of liquidity. Now the thing is, those things were October 2008. That was not a long story. In that month, they were starved for cash. By November, December, the world had changed. So you need to tell a very focused story that there was a cash crisis in October 2008. There was no cash crisis by December. By December, that problem had been solved. Whereas dividends is a much longer, is a slower story. Yes, Josh?
Yeah, I was going to make exactly that point, but let me make a different one, which is that you're telling a causal story, right? Dividends moved from China to the foreign investors, and because that money went out, firms had to cut their investment, right?
Yeah.
Now, the problem I have is that can only happen if these firms in China are financially constrained. That is to say, remember, you can only pay dividends out of profits, right? So that means that they were relying on internal cash generation in order to fund their investments. They could not depend on external finance.
You can
to
borrow and
fund.
pay dividends. You cannot.
But that's exactly my point. So if you can borrow, then sending dividends abroad shouldn't affect your investment plan. So you have to, and we know that precisely during this period, China reacted to the crisis by completely opening their credit taps. They embarked on the biggest credit expansion the world has ever seen. So I find it, now maybe you're going to argue institutionally that these foreign invested firms had no access to the capital that the Chinese banks were pumping out. Maybe that's true, but I need to see that evidence before and some proof that these firms were financially constrained before I can buy the causal story.
Okay, shall we stop on the comments and give Abhinav a chance to respond?
Thank you for the comments. We have been basically facing challenge with in terms of who's the ultimate owner, and unfortunately that data is.
May I suggest you check the paper by Goyal et al.
Can you use the mic, please?
Yeah, so they have a sample that they collect from different sources, right? May not cover China, but they actually cover India and several other countries. And so as a result, see if the kind of story that you have there also applies.
Could you please tell us, which is this paper?
So it's a RFS, actually that paper is the basis of another paper.
Oh, the Gopal and RFS paper, okay, got it. Yeah.
So business groups and investments basically, where they look at 2 years group investments when the firms, the parent company is paying out high dividends. So yeah, thanks for the suggestion. But the thing is basically the ultimate identity is not disclosed in this case. We search a whole bunch of different databases. The only alternative that we are left with is basically go through these firms' annual reports year by year and then try to figure out what exactly is happening or who's the listed owner.
Since these are not changing, these are the controlling state, right? They own 40% of the, the equity of the firm. It's unlikely to change so much from year to year. So you may just do it once and then good for.
Besides, it's 801 firm years, so I'm sure it wouldn't be more than 150 or 160 firms. So, yeah.
Okay, so if we are at the end of this, then may I please ask Susan to close the day?
I close the day. And we'll see you back here. We'll see you back here at 9 a.m. tomorrow. Thank you.